There's no more recession in sight. At least that's according to the IMF or the International Monetary Fund, and even Forbes put out a piece saying that our economy is set to boom, not slow down. Even Janet Yellen came out and said that inflation is on the right track, so far so good. And even President Biden came out and said that he expects no economic slowdown in the coming years because our economy is so strong and booming. Now, nobody can perfectly predict a recession or a market crash, but what we can do is look at the numbers. So today, I want to look at the numbers. Starting with inflation. Inflation is still much higher than what the Federal Reserve Bank and the government expected it would be at, and these higher prices are pushing more and more Americans into credit card debt. But let's actually quantify what this means, because between 2020, the pandemic, and now essentially, inflation has caused the price of things to go up by around 15.2%. Now, I should also point out that this is just the reported CPI inflation levels. The inflation that many people actually experience is many times higher than the actual reported numbers. A general rule of thumb, especially on the internet, is you take the inflation number and double it, and that's the real inflation that many people feel. But this is the reported inflation number, 15.2% over the last, well, since the pandemic started. Now let's compare this with wage growth. In 2020, wages grew by around 2.6%. They grew by another 5% in 2021 and then 5.1% in 2022, according to the Bureau of Labor Statistics. That means if you were earning $100 in the beginning part of 2020, now you'd be earning $113.22. That means you saw 13.22% wage growth. So wages have grown quite a bit since the pandemic started, which looks pretty good. But when you compare that to the inflation numbers that we're seeing, now it doesn't look so good because the prices of things have risen faster than people's incomes. This is where you might look at these numbers and say, if people aren't making as much money relative to inflation, you'd think that people have to cut back and live smaller, right? And spend less money. Well, that's not what we've been seeing. The latest report, which came out at the end of February, showed us that spending is growing at some of the fastest rates that we've seen in years. This is where you should be asking the question, what does this mean? Because if inflation is rising faster than wages and people are spending way more money, is this good or bad? Well, it depends who you ask, because banks are saying this is great news. It's showing how strong the consumer is. Bank of America even put out a whole piece on their website talking about how strong the consumer is because of how much money they're spending on their debit cards and their credit cards. They're showing that consumers are spending more money than really ever. The latest data has showed us that in 2023, wages have grown by 0.9%, while spending has increased by 1.8%. People are spending twice as much as the increase of their wages. Why? This is where you have a lot of people and entities like banks, like I just showed you, and the government and the Federal Reserve Bank, who keep saying it's a sign of how strong our economy is, because this is where our data stops. Our data shows us how much money people are spending relative to inflation. And what we see is that people are spending more money, which shows, hey, the economy is strong, people have the ability to spend. So they're all assuming that people are buying more things. But what we're not really factoring in is, are people actually buying more things? Or are they just paying more money to buy the things that they want to buy in the first place because now this inflation is so high? And how are people actually affording these more things? Well, let's look at the data. Because while we don't know how many things people are buying per se, we know that people are spending more money. That's what we talked about so far. But how are they actually spending this money? Let's talk about that. Well, what we can see is that credit card debt is rising and people are digging into their savings accounts to fund their spending. And in addition to that, the personal savings rates, the amount of money people are saving relative to their incomes, is near an all-time low. Actually, in January 2023, Bankrate did a study on personal savings rates. You might remember this if you were subscribed to Market Briefs. We covered the story there. But Bankrate did a study where they covered personal savings rates, and what they found is that nearly 4 out of 10 Americans are now digging into their emergency savings funds, in order to fund their lifestyle. By the way, if you haven't joined Market Briefs yet, it's a completely free newsletter that I created to help investors like you stay up to date on what's happening in the financial markets. It's super easy to read. You can read it in less than 5 minutes every morning, and we keep you updated on what's happening in things like the housing market, the stock market, the crypto market, the global economy, and our own economy. It's super fun to read. If you haven't joined Market Briefs yet, I'll put the link to how you can join for free down in the description below. See, this is the difference between data and analysis. Data shows us that yes, while wages are not keeping up with inflation, the consumer is still strong. People are still spending money. In fact, people are spending even more money than before. How are they spending this money? Well, with the help of their savings, with the help of their credit card debt. The analysis then is you have a lot of people, banks, the government, the Federal Reserve Bank, who are saying this is a sign of how strong our economy is. This is a sign of how robust our economy is, and this is why we have nothing to worry about. Another piece of analysis is maybe these are red flags. Maybe this is a sign of potentially red flags in our economy because people can only dig into their savings for so long. People can only go into credit card debt for so long until they have to really cut back on their spending. And when we see more of a cutback on spending, that would cause more pain in the economy. But right now, if we just take a snapshot of the economy, everything looks good because people are spending money. People have savings that they can dip into, and people have credit cards that they can max out. This is why I don't want you to blindly follow someone's headlines, but rather create your own analysis. Read the raw data, understand the analysis that you create yourself. Because people like Warren Buffett and Charlie Munger, who have the firm Berkshire Hathaway, have read the data, and with their own analysis, this is why they're now sitting on the largest cash pile ever. Berkshire Hathaway has almost $90 billion of cash saved up. And if you read a little bit deeper into this analysis, Charlie Munger, who is Warren Buffett's right-hand man, says that growing up in his entire adult life, he has never hoarded cash. He just invested his money into the best thing that he could find. But the reason why they're not investing right now and why they're hoarding cash is because, quote, there's nothing that they can stand buying. Their thinking is essentially that there's a lot of red flags in the economy that can cause pain in the economy, which could cause asset prices to go down. I mean, in the beginning part of 2023, Bloomberg put out a piece on car payments in America, and what they analyzed was that more and more Americans are now underwater on their car payments. Why? Because there are a lot of Americans over the last number of years who are financing expensive cars, maybe even overpaying for cars, using as much debt as possible. Now, as we're starting to see the economy shift, car prices have gone down, and now you're seeing more and more Americans underwater on those same car payments. So what does that mean? Well, I guess time will tell. And a lot of people have no patience where they say, oh, we have to have a recession, or we don't have a recession, or we haven't seen a market crash, so we're not going to see a market crash. And now you're seeing more and more kind of savvy investors saying, well, I think there's red flags, so we're going to sit on the sidelines, or we're going to use our money in this particular way. And you have other people that are saying, nope, nothing bad can ever happen. Everything is going to go straight up forever. What I want you to understand is learn how to do your own analysis. Understand that you shouldn't just follow headlines, but read the data and then create your own analysis based off of that, because every single person in the world has an opinion, and you need to create yours instead of just blindly following a random guy on YouTube or anybody else. See, our economic system is made up of three different parts. We have the economy, which are the businesses that make up the economy. We have the investors that own a piece of the economy. Anybody can be an investor, but most people are not investors. The people that win in the long term in our economic system are people who are investors, who own a piece of the economy. But then you also have consumers. This is everybody. Rich people, poor people, middle class people, even businesses. Everybody is a consumer because everybody consumes things from the economy. Now, how does our economy work? Well, our economy works when consumers spend money in the economy. When consumers go into debt to buy things in the economy, when consumers go into credit card debt to buy things, they finance everything. Well, that actually helps the economy grow even faster. When people spend more money goes into the economy. This benefits investors because now the investors who own a piece of the economy are making more money because consumers are spending more money. This is the situation that we're in right now, where consumers are spending a lot of money in the economy. Why? Well, some people want to buy a lot of nice things. And the second factor is because of, well, inflation. The price of everything keeps rising. Consumers are being forced to spend more money. How are consumers spending more money? Well, they're digging into their savings. They're spending money on their credit card debt. Some people are earning more money. So consumers are spending more money in the economy, which is helping investors. Now, what happens if we hit a breaking point? Consumers no longer can go deeper into credit card debt. They no longer can keep going into their savings. What happens then? Well, then consumers won't be able to keep spending money in the economy. If consumers can no longer keep spending money in the economy, now the economy can't keep growing because that means businesses are now making less money. They're not selling as much stuff. And that means then investors and the investment market would also get hurt too. That would then create opportunities because, well, if the investment market is getting hurt, you have distressed assets, and that creates opportunities for people to buy distressed assets, good assets at a good price, meaning a discounted price, but you have to have money and the financial education to do that. That's what we talk about on this channel. But this is the concern that you have a lot of people seeing, that, hey, this is not sustainable because the prices of things in the economy are rising faster than how much money people are making here. People are having to spend faster than they earn. And if you're spending faster than you earn, eventually you're going to hit a breaking point. Sure, you can dig into your savings. Sure, you can spend your credit card debt. But eventually there's going to be a breaking point, because if people keep earning less than what they're spending, well, you're going to hit a point where you can't keep spending more money. When will that happen? Well, only time will tell. But this is the situation that we're in right now. And this is where, again, I'm going to say this one more time. There's data and there's analysis. And I want you to understand the data. That way you can create your own analysis. And we'll see in a few months where things go. But it doesn't look like this pain in the economy is going to stop tomorrow. The next 12 to 18, 24, 36 months are going to be a bumpy ride, and this is where you want to make sure you protect yourself and don't just trust the headlines, but rather create your own analysis by reading the data, and that's what we try to cover in Market Briefs, my free financial newsletter. At first, everybody kept saying that these layoffs are contained to the tech sector, so we don't need to worry. Well, it doesn't look like that's the case anymore. From big tech to banking to retail, more and more sectors of our economy are either slowing or beginning to slow. Now, while most people are quick to blame the layoffs on inflation or interest rates or